Decades. Throughout most of modern history, it was thought that prudent government debt management involved bringing down the ratio of debt to GDP during quiescent periods of growth in order to store fiscal ammunition for the next crisis. In the 1800s, the United Kingdom used debt to fight one war after another, taking advantage of the time in between to repair its finances. Likewise, although the U.S. debt-to-GDP ratio was very high during World War II, it quickly declined in the years that followed. Policymakers feared there might be yet another. To pay for the Korean War, the Eisenhower administration famously raised taxes instead of relying mainly on debt. But in the years following the global financial crisis, the persistent very low interest rates that took hold caused a number of leading economists to question this orthodoxy. In his influential theory of secular stagnation, Lawrence Summers posited that real interest rates would stay low indefinitely because of adverse demographics, low productivity growth, and weak global demand. Others, such as Paul Krugman and Olivier Blanchard, suggested low rates were a silver lining, allowing aggressive fiscal policy without worrying too much about the cost. Some argued that reliably low rates made deficit spending a low-cost path to social investment, a view embraced by progressive politicians eager to fund bold priorities. To be fair, Democrats were hardly in universal agreement. Even as he ran outsized deficits to pay for progressive priorities, Biden signaled he hoped to meet costs by raising taxes. By contrast, Republican administrations continued to espouse that deficits did not matter if used to pay for tax cuts, betting growth would turn deficits into surpluses. As debt debates became politicized, economists who questioned the lower rates forever orthodoxy were often shunned or ignored. Anyone looking at long history of interest rate fluctuations would have seen a return to higher rates was likely. The 10-year inflation index Treasury rate fell sharply after 2007 for reasons tied to the crisis. True, aging populations and slow productivity persist, but there are many reasons to think long-term interest rates will remain higher into the future. Government debt is exploding globally. G7 net debt to GDP rose from 55% in 2006 to 95% today. Japan's net debt to GDP is 134%, Italy 127%, France 108%, the United States 98%. Other pressures: rising populism pushing domestic spending, AI's appetite for electricity, tariff wars forcing reshoring, and the cost of adapting to climate change. Some economists have begun to reconsider the seductive assumptions of the 2010s, but there is little sign Washington has. With high interest rates, elevated debt, political upheaval, and pressures on Fed independence, a fresh shock could precipitate a broader collapse. One scenario: a collapse of confidence in U.S. Treasuries, a crack in the bond market, causing a sudden spike in interest rates. Alternatively, yields could rise gradually over months or years as investors worry about safety of their money. Rising rates can push down stock and housing prices, make business investment harder, and raise the cost of servicing government debt. If the government responds by running bigger deficits to stimulate growth, markets may smell blood and push rates higher still. To escape without crushing austerity, governments may reach for heterodox options often seen in emerging markets. Options include outright default, using inflation as a partial default, financial repression, or new tools like dollar stablecoins. The United States has defaulted before. In 1933, Roosevelt abrogated the gold clause, devaluing the dollar, a controversial default in the eyes of the Supreme Court. A simpler option is high inflation to erode debt, but this risks damaging the economy, as hyperinflation examples show. Financial repression means forcing savings into government debt via banks, pensions, or central bank purchases, lowering interest costs for the state. Governments used repression after World War II to inflate away debts. Japan today holds huge public debt and uses repression with mixed growth results. A newer option: dollar stablecoins. 2025 U.S. legislation requires reserves in treasuries and bank deposits, potentially creating a captive pool for government debt. A Fed digital currency would be government-backed. Private stablecoins could be more innovative but pose run and audit risks. The status quo, ignore the debt and hope for growth, is a huge wager. Left unchecked, rising debt could erode America's ability to respond to crises and sustain global power. The United States may avoid a debt crisis, but policymakers need to contemplate the options now, before the next shock arrives.